Using internal accounts is an efficient means of executing internal funding transactions via a debit to the central in-house bank account and simultaneously generating a matching credit to the subsidiary's account.
Welcome to Actualizing Success. In this podcast series, our in-house advisors discuss today's finance and technology topics with an emphasis on solutions that embrace tomorrow.
An in-house bank provides an internal current account structure and other services to group entities, which replicate the services typically provided by an external bank. In-house banks provide services similar to those of a commercial bank, such as offering payment processing, liquidity management, and collection functions to various subsidiaries of large global corporations. For a visual, think of a checkbook. You have an opening balance for the month, receipts and disbursements, and an ending balance. In the case of an in-house bank, corporate can optionally pay interest if the participant is in a positive position, or they can charge interest if they are in a negative position with the bank. The benefits of an in-house bank include improved operational flexibility. By implementing an in-house bank, there exists the opportunity for improved operational flexibility, especially when integrating multinational businesses. The in-house bank can also serve as the building blocks to a corporate center of excellence, offering expert banking transaction-related customer service to the subsidiaries or participants. Lower external borrowing. The in-house bank will lower subsidiaries' need to borrow at high local rates, while others invest surplus cash at low rates. In an in-house bank, they will borrow from or lend to each other and go to the bank only to cover the net shortfall or invest the net surplus. Lower external FX transactions. In-house banking will lower the volume of external FX deals. With an in-house bank, you will offset the trades and pay the outside dealers only for trades you need to cover the corporation's net needs. Improved visibility. In-house banks enabling pooling of all investable cash or short-term borrowing, corporations can command lower loan rates or higher investment rates for larger parts of the business. By streamlining accounts, corporations often can reduce maintenance fees and reconciliation tasks. Another benefit is lower costs and bank independence. Implementing an in-house bank using a single technology for communication with the banking environment will result in lower costs and a greater degree of bank independence. The key functions of the in-house bank include cash pooling, centralizes group cash balances to optimize liquidity, intercompany lending. The in-house bank provides loans to subsidiaries at better terms than external banks can provide. Foreign exchange management conducts internal FX deals between entities and hedges externally only for net exposure. And payments and collections centralizes outbound and inbound payments, often using payment factories. This is referred to as payment on behalf of or receipt on behalf of. Key considerations when implementing an in-house bank include technology, location, tax implications, and regulatory issues. When implementing an in-house bank, tax and legal should be a part of the conversation from the beginning planning stages. Topics may include tax impacts in certain countries, local taxes, thin capitalization, transfer pricing, and VAT on interest. Withholding taxes on bank interest is required in some locations as well. This will require a review of regulatory environment for each country. Questions such as, are payments on behalf of allowed in this country? What will be the treatment on cross-border payments? And what paperwork needs to be put into place? There are some challenges and risks to also consider, such as regulatory restrictions. Some countries limit intercompany netting or FX internalization, tax and transfer pricing, must avoid profit shifting and comply with regulatory guidelines. Operational complexity requires strong treasury governance and skilled personnel to maintain the in-house bank. And system integration, difficulties in aligning global systems and data flows are common. In conclusion, in-house bank programs can provide deep financial and operational benefits for both subsidiaries and corporate treasury alike. Using internal accounts is an efficient means of executing internal funding transactions via a debit to the central in-house bank account and simultaneously generating a matching credit to the subsidiary's account. A treasury management system can also automatically track transactions and perform interest calculations, as well as generate in-house bank statements to the subsidiaries or participants. An in-house bank program may not be the right choice for every company. However, for those meeting certain key criteria, typically large multinational corporations with multiple business units and high volumes of intercompany transactions, there are many benefits to establishing this model. More and more companies are looking at the possibility of using an in-house bank to increase efficiency, reduce banking fees, and improve visibility and control. An in-house bank is a powerful tool for global treasury optimization. When properly implemented, it enhances financial efficiency, visibility, and control, turning the treasury function into a strategic business partner.
Thanks for joining us for today's episode of Actualizing Success. Make sure to visit us online at www.actualizeconsulting.com, where you can explore our service offerings. Don't forget to subscribe to the show on iTunes, Spotify, or your preferred platform. If you've enjoyed what we talked about today, please consider leaving a review and following us on LinkedIn. If you have any questions or would like to share your opinions with us, please send us a note at podcast@actualizeconsulting.com. We look forward to hearing from you.